Hi, this is Nate Brown, the marketing specialist here at Alpha Wealth Group, and you are about to view the recording of the Long-Term Care Masterclass. Long-term care expert Mike Swayze did a great job discussing this topic and sharing some knowledge on the subject. As always, if you want to discuss your own unique long-term care situation, simply call us at 630-519-4742 or click the link in the email to schedule your one-on-one private long-term care consultation. With no more delay, enjoy the Long-Term Care Masterclass recording.
My brother lived in Richmond, Virginia. Years and years ago, I was having a conversation with my parents and my brother, and it said, look, at some point, you're going to need help. Where do you want to go? You either have to move closer to Dave, my brother, in Richmond, or you're going to have to move to Atlanta. Which one would you prefer? Makes no difference to us. Well, they moved earlier this year to Richmond. Helps my brother, helps me. It is an hour closer by drive. It's closer to the airport, all that fun stuff. But it also gives me peace of mind knowing that my parents can be taken care of easily, quickly, when and if something happens. Great things, my mom's in great health, but my dad, not at all, right? So my brother's there constantly, and it wears on. So where do you want to live? Same conversation I just had, right? It can be geographic, but it also is facility or at home, okay? Has anyone toured or been in an assisted living facility? Yeah. Some are better than others. Yeah, we all agree about that. The bad ones you've been in, what's the first thing you know? What's that? Walk out the door. Yeah. Smell. Yeah. I encourage everyone in here, if you have not been in one or toured one for your own personal use, do that. Ask the administrator questions. How many folks are on Medicare, or not Medicare, Medicaid, right? What's their bed system like? How does it all work? How does it come together? They're a wealth of knowledge, but make sure it's a place that you like. Have your kids go with you, your grown adult children, have them go with you. Make sure everyone's on the same page as to what this looks like. But that little kind of document in there that's in that book is a great place to just jot down some notes. When we were talking to my dad years ago, my dad simply said, you know, and this is very common. He kind of, that's 95% with what I hear and what I do every day. I don't want to be a burden to you guys, me and my brother and I. I don't want to have you kill your mother before I die. And that is not uncommon where the caregiver becomes more sick than the person they're providing care for. It is a very thankless, very challenging job. So when I can't care for myself, put me into a facility, knowing they're going to fight you tooth and nail. Anybody have experience with that? Yeah. What you can go back to once you've had that conversation is I can keep reminding my mother, we had this conversation, remember? And dad said, this is the right thing to do to protect everyone else. So right now she's having that fight internally with herself, but at least we can go back to what he said to that conversation. It's a much, much different thing if you never had that conversation and you're having to make these decisions on loved ones. Right? At what point do we pull mom or dad out of the home and put them in a facility by themselves? Right? That is not an easy thing to do. Create a plan. Who's providing care? Where's that care provided? What does that whole picture look like? That document could be a big help, kind of walking you through that scenario. That make sense? Cool. Any questions so far? All right. Once you start to put together that type of a plan, you can start to have a conversation on, okay, everything has a cost, right? I want to go on vacation. What do we want to do? Let's put that plan together. And now how much is that vacation going to cost, right? Or we can go backwards. I have X amount of dollars. What can I get on vacation for that? It's really no different with this, okay? There is a cost. These are national numbers, all right? I took the few minutes and I looked up some Chicago area specific numbers for non-medical caregiver. Currently here in greater Chicago area, these are median numbers. So it's the middle. It's not an average, it's just the middle number. You'll find higher or lower. Just over $7,000 a month. Does that sound right? Anyone have experience? Sounds kind of ballpark it? Yeah. An assisted living facility, it's about $7,300 a month. One number that is maybe one of the most meaningless numbers, I want to say meaningless, that's too harsh, but least consequential numbers is what does it cost today? Because ideally, none of us are checking into an assisted living facility today, right? Hopefully that's not on the goal for someone tomorrow, right? So I also did a projection 25 years from now. So 60 years old, require assistance at age 85, whether it's home care, assisted living facility, what does that look like? This is assuming a 3% average annual growth rate. And by the way, that non-medical caregiver, which was $7,000 a month, that's at 44 hours a week. Anybody know how many hours are in a week? Nice. 168. So who's providing care for the rest of those 44? It's a great question that has to be answered, right? Generally, 44 hours a week is used because it's a 40-hour work week and then some commute time to get home and back where you can care for mom or dad, right? But if that goes to 60 hours a week, that goes up dramatically. You see the hourly rate there, 35 to 45 bucks an hour is the general rule of thumb. And usually it's about a 4-hour minimum for someone to come into the home. So it adds up very, very quickly, right? But in 25 years, 3% growth rate, that non-medical caregiver expectation, about $14,700 per month. That's $177,000 a year. Assisted living facility, $15,300. That's $184,000 a year. Those are big numbers, right? I don't share those with the intent to scare anyone. That's never what I want to do. But I want to put some of those in perspective. Does anybody know how old the baby boomers are turning this year? The oldest of the baby boomers. How old are they turning this year? What was it? 80. Nailed it. Yeah. That's 2 for 2. I like it. 80 years old. The reason I bring that up is we don't see long-term care claims spike into early to mid-80s in the insurance companies. So I think 82, 83 is when that we kind of start going vertical on that bell curve from a claims perspective. So with that knowledge, we haven't reached the baby boomers that are really negatively impacting the caregiving networks in our community. They're starting, but what's it going to be like in 5 years? And that's a hypothetical kind of rhetorical question, right? Just something to think about. If I project at a 3% growth rate, which is what all the calculators out there do, and you can type in long-term care, cost of care calculator, and you'll get 15 different things, and they all kind of lead to the same place, the same numbers. Over the last 6 years, the average growth rate, average annual growth rate for home care and assisted living facilities is right about 6%. Okay, some years it's been 10, some years it's been 3. It's kind of, moving around, but it's on this trajectory, right? So we've got the baby boomers aging, which we know. Caregivers are challenging to find. Has anyone worked with a caregiver before? It's a very, very hard job. It is thankless, especially if it's cognitively based, right? You could take the sweetest person you've ever met in your life, give them some more advanced Alzheimer's, and it is a different person than what you knew growing up or through life, right? Short story, very, very hard to find caregivers. We do not have enough of them already. We do not have enough facilities already. But as our baby boomer generation continues to age, we're going to see that, in my view, continue. So could that be higher? Yes. Will it be? Please don't say, hey, that guy Mike said it's going to be $190,000 a month. It's not at all what I'm saying. What I'm saying is the need to plan is very, very important. Okay, because this is a very extreme cost and it will impact finances. The reality comes down to there's only 4 ways to pay for this. Okay, 4 perceived ways. There's actually less than that in my mind. We can self-fund, let's pay out of pocket, and I'm going to dive into each one of these. Rely on our family to not only provide care, but maybe even pay for care. We can rely on the government. That's always a fun one. And then we can use some type of insurance or risk transfer vehicle, right? So if we start with self-funding, has anyone heard the term self-insuring? Okay, that's not a thing. Okay, so the concept of insurance is large groups of people getting discounts and providing leverage on whatever premium dollar they're paying, right? So in this aspect, self-funding is just, I'm just going to pay for it, okay? If you have a net worth of $10 million, you're not going to run out of money, and that is a great position to be in. But when we look at the pros and cons of self-funding, the pros are fantastic. If I'm willing to write a check and someone's willing to accept that check, I can pay for whatever type of care, wherever I want, however I want. Doesn't matter. As long as someone's willing to cash that check and perform the services needed, I'm good. No one can tell you what you can or can't do, right? If you want to go on a cruise and have at it, buy the boat if you want to, whatever, right? The negative side of self-funding is a couple of things. Tax consequences. Tax consequences come in. Let's hypothetically say my wife and I are living off of $100,000 a year in retirement combined, and we're just going through life. We're happy and giddy. Wake up one morning, I'm unable to do many of those 6 ADLs. And if my care, I'm going to kind of ballpark a number here, if my care costs $150,000 a year at that point in time, well, now our taxable income, well, let me back up. Taxable income is $100,000 for the two of us. I require care, paying out of pocket. Now I'm taking in $250,000 because my wife still has a life to live. We still have the bills to pay at home, right? I require care. That's a net of $150,000. Eventually, I'm going to burn through some of those liquid tax-free assets, right? The easily accessible cash. And I'm going to get to those qualified accounts. I'm going to get to those taxable accounts, right? So if I need 150, how much am I have to take out to get to the 150? 180? Ballpark. See where taxes are when this happens. But you understand the point I'm making. So what was a taxable income of $100,000 is now a taxable income of 200 plus about 250,000 plus, right? It's called negative leverage. So for every dollar of care I need, I'm having to sell an asset of $1.20, $1.30, somewhere in there. And we're not talking $1, right? Just puts it in perspective. We're talking tens of thousands of dollars, right? That's the negative side of self-funding, okay? Tons of flexibility, the most flexibility, but the tax situation and the lack of leverage can cause some problems for a lot of folks. Relying on loved ones. I said earlier the phrase, I don't care, I just don't want to be a burden to my family. That's the most common thing that I hear. The number one thing you can do to not be a burden to your family is plan and talk to your family about your plan. That's the number one thing, right? It's not buying insurance, it's not doing something else. It's having a conversation so they know what your wishes are as we age, right? That's me, that's everyone in this room, okay? Have a conversation, right? So I'm not going to say that enough. The downside of relying on family, well, the upside is they're known, they're comfortable with each other, right? My dad actually, still recognizes us, still knows my name, which is great. So I go in, I help out for a few hours, let mom go take a little break, go get lunch, whatever. And it's hard to talk to. If you ever try to talk to someone with Alzheimer's, it does a conversation that doesn't really go far, and it kind of meanders a little bit. But nonetheless, it's known. It can be very affordable. The cost is going to come. When I look at my mother, for example, the cost is right there. It's her personal and emotional, physical cost that she's paying day in and day out for providing care, right? Now, if that care is being provided by, let's say, my brother, whole different story. Does he have the time? He has 2 young kids. He's a teacher. He works full time. It doesn't work? Not really, right? So if you're going to go the route, and I'm not here to say one of these is necessarily better than the other, I'm saying they all have pros and cons. And I am saying if you're going to go down the route, and all of these kind of combine at some point, right? You're self-funding, family's going to be involved because they want to be, they think they should be, and they rightfully so they should be. But make sure there's a willingness with that family member or family members. Make sure the availability is there, right? I've got 3 young boys at home as well. They're not really young, 19, 17, and 10. So my time is very challenging, especially with what I do for a living and traveling. If my mom had chose to move mom and dad to Atlanta, that would be a pretty different dynamic at my house right now. They wouldn't live with us, but you understand. And that emotional impact on caregivers is key. So make sure you have that conversation with those family members so that way they know, hey, we're targeting this. Are you okay with that? Even if they volunteer, make sure they are aware of what's getting into it. Government. Who would be happy with the government taking care of it? Not going to turn it political, don't we? Medicare and Medicaid. Okay, so just pure FYI, this is where a lot of misinformation, a lot of kind of false things are out there. Medicare does not pay for long-term care coverage. Medicare is health insurance. Long-term care is custodial care. Okay, that is the big difference. The only way Medicare will cover some long-term care coverage, right? This is the 2 ADL aspect or severe cognitive impairment, is if you have, and I believe it's a 3-night stay in a hospital, followed by a direct transfer to a rehabilitation facility, and then they will cover up to 100 days to a varying degree. It's a shared cost at that point. And it'll cap out and end at 100 days max. Okay, so you get 100 days, maybe, if you have the required, I believe it's 3 nights in a hospital stay. It used to be 2, so they keep pushing it out. All right, not easy to do. I keep going back to it. My father never had a night stay in a hospital. Medicare is not taking care of it. It's taking care of the neurological visits, taking care of the doctor visits, but not taking care of care. There's nothing there, right? Medicaid does. Medicaid will pay for long-term care. They will pay for facility care, okay? They're not going to have it come to your house. You're going to go to a facility. Remember that conversation about the smell of some facilities? Yeah, walk into a Medicaid facility and that's what you're going to get, okay? That's why I say tour some of them. It can look great on the outside, and the inside, not so much, right? But Medicaid will. The downside to Medicaid is you're going to have to deplete your assets significantly. There are provisions for spouses and homes and those sorts of things. I'm not a Medicaid expert, but most folks don't want all of their assets going away and the overwhelming majority of income going towards Medicaid. Okay, you don't get to pick your facility. Could be 20, 30 miles away, depending on where a bed is available. Okay, make sense? Any questions on Medicare, Medicaid? No? All right.
Can I make a comment about that? Because we went through this with my mom. That when she had to go to a skilled nursing facility, right? And we knew that she wasn't going to be able to live by herself, we made sure that the one that she went into also accepted Medicaid when she spent down her money. So there's a lot of them that don't do that.
Correct.
And being able to be there as a more regular skilled nursing facility patient, the transition to the Medicaid is easier. So, and that's in that realm, we were able to pick the place that she wanted. But some facilities that are Medicaid only are
correct. And you were able to pick because it was paying out of pocket initially to start. And that's a very, very great point of understand what the financial situation looks like. Medicaid is fantastic. It absolutely is. It does exactly what it is supposed to do. The downside of it is it takes away some of that flexibility. So if you may end up on Medicaid, that's a whole different thing. I can pick where I want to start, and then as my assets deplete, I then qualify for Medicaid, and I don't have to move. But to your point, not all facilities, and it's becoming more and more, where facilities don't prefer to not accept Medicaid.
Right.
So not all of them do. They don't have to, okay? And then the fourth option is the world I live in, which is some type of insurance vehicle. Now, you guys have all heard of long-term care insurance, yeah? Premium increases. Anybody have experience with that? Premium increases on long-term care policies. You heard about those, right? You can Google it and it's everywhere, right? So, 2 main types. There's a whole different subset, okay, of long-term care related solutions, right? Traditional long-term care insurance, these go back 30, 40 years, right? So these originally started as nursing home policies where you had to be into a nursing home before it started kicking out benefits, very rigid, fairly high premiums. Still to this day, they have non-guaranteed premiums. Your premiums can go up over time, right? They're going to illustrate and show you a flat level premium, but in the fine print, it's going to say, hey, if at some point the insurance company deems we're underwater on this pocket of business, we can increase those premiums with approval from the state. And that is currently happening with most enforced traditional long-term care insurance policies. Use it or lose it refers to I can pay premiums. I can buy a policy at age 60, pay premiums all the way through age 90, drop dead, never needed long-term care, and my family gets nothing from that policy. I got nothing from that policy because it only provided benefits for LTC. There was no death benefit component to it, okay? So that's kind of the older version. There at one point were about 135 companies, insurance companies, selling traditional standalone long-term care insurance. Okay, so a whole boatload of them. Today, from a viable company perspective, there's about 7. So it tells you what the market has been demanding over the last several years. Hybrid life insurance, this is the world I sit in specifically. was really invented and created to answer all of the negatives that traditional long-term care insurance has. Before I get into that, traditional long-term care insurance does do one thing really, really, really great. For the premium dollar, they will give you the most long-term care benefit in the market, hands down, bar none. They have lower premiums. I don't know why it says premiums can be expensive. So if older, you can pay monthly, it can be auto drafted. They can seem much more affordable for the benefit you're buying. Okay, there's just not a lot of additional usages other than straight long-term care. Okay, the hybrid world, again, that's the world that I live in, sought to fix a lot of these, and there's a lot of competitors out there with me, right? So it's not a one-size-fits-all, but we all have guaranteed premiums. We all provide death benefits. Those death benefits are equal to or greater than the premiums paid. So if I bought one at 90, paid all my premium, bought one at 60, paid all my premium, died at 90 with no LTCD, death benefit, tax-free, paid to my beneficiaries, always equal to premium or greater. Most folks kind of think that's a bit of a better story, but the premiums can be a little bit more expensive because of all that flexibility built in, right? There's return of premium privileges, and over all of the products, generally what you're going to find is issue ages 30 to 80, maybe even 85 in certain scenarios. You can find single pays, 5, 7, 10, 15, 20, all pays, pay to 90, pay to 100. You think of it, it can probably exist in that space. So it's a lot more flexible. There's a lot more competition out there than the traditional long-term care side. But again, traditional LTC, for $1 of premium, I'm going to get the most LTC benefit out of that, and everything else is kind of fighting for second spot. Does that make sense? Yeah. All right. So what we do a lot in the hybrid long-term care space, we affectionately call it asset-based long-term care. A lot of the times, folks choose to buy it with an asset, meaning I have my portfolio, right? My pencil portfolio here, a little more simplified than the 300 pencils I brought. The green, we've got our retirement savings, investments. The light blue, tangible assets, home, cars, cabins, all that fun stuff. The dark blue is the liquid assets. Those are the things that money market accounts, CDs, checking accounts, savings accounts, all that just more easily accessible. Probably have some life insurance in there. We should probably add an annuity bucket in there. When we're having conversations on, okay, I should do something to create leverage and go down that route. How do I figure out what do I do? How do I pay for it? How do I fund my long-term care plan? Some folks, not all, some say it's the answer to the question of which asset would I choose if I needed help and support tomorrow? So you can just think in your head, where would that first check come from for $8,000 or $7,000 in today's cost? Where would that first check come from? Great. Would it make sense to take a portion, never all, a portion of an asset? Maybe it's the dark blue here, which again, that was the liquid stuff, low yielding, low earning, easily accessible cash. Does it make sense to take a portion of that and fund some type of risk transfer vehicle? Now, let me be very clear on something that I haven't said yet. When I share those numbers, in 25 years, an assisted living facility could cost $15,000 a month. The goal of any type of long-term care funding solution is not to cover 100% of the expected need. It's not to get to 15 grand. If I can get to 5, if I can get to 7, that's $5,000, $7,000 each month, maybe more, that I am saving, that I am protecting, that I am getting in tax-free. Remember, these benefits come out tax-free, and preserving the rest of my portfolio, the rest of my assets. In addition, these come with additional benefits I'm going to talk about in a second that provide support for the family. They provide resources. It's called care management or care concierge. So as you're going through this claim, you're not alone. Okay, and that is a big, big, big. One thing that everybody hates to talk about is our own health. The only downside to insurance is you qualify with your health. Okay, there are a lot of different options out there. As I mentioned, there's traditional long-term care insurance. There's a world of hybrid solutions There's life with chronic illness riders. There's life with long-term care riders, which are just accelerating the death benefit early. There's long-term care focused annuities. There's a whole bunch of different things that work together. What this represents very poorly is as we age, our health tends to not get better, right? I know I have not gotten healthier over the past 15, 20 years. We qualify with these with our health. The healthier we are, the more leverage we can get, okay? You don't have to be on no meds. You don't have to be, crystal clean. You can have a few extra pounds. It's not it. What we want to try to do, and you'll see it inside the folder, there's a piece that looks like this. It's the pre-screen questionnaire. It asks some general health questions. You don't have to share this with anyone, but if you would like some more information, you can complete this. You can share it with Tom and Emmett, or Tom or Emmett. And what they can do is put together a bit of an idea of, okay, this is what you could potentially qualify for. I represent one company, one product. Tom and Emmett, they have access to every single product and company that's out there that exists, of all highly rated carriers, okay? Some of my best friends are my biggest competitors, all right? My company is not a fit for everyone, right? No one is. My point is, that's a great starting point, is kind of go through health. What they're looking for, what am I currently being treated for, and what have I been treated for in the past, especially the big stuff, okay? The little things are still important in the LTC world. If you just had, a bunion removed on your toe and you have a walking boot, for example, that's a problem in LTC. That has no impact on your life expectancy, but currently I have an assistive walking device is the way insurance companies look at it, okay? So just to put a little perspective. So as we age, our health tends to deteriorate. So it is important to have these conversations now, today, because we're generally healthier today than we would tomorrow. Any questions on anything up to that point? All right. So as I mentioned before, my goal here is to not sell you something. It's just to give you an idea of what one of these options looks like. So the option I represent is called SecureCare 4. It's our 4th version of this product. And it is simply designed to provide leverage, tax-free income when you qualify using 2 ADLs or that severe cognitive impairment. Okay? It is really as simple as that. There are some things to it. We affectionately call it a live, die, or quit scenario. Okay? So I always use myself as an example. If I live long enough, I know that at some point in time, I will need care. If I just keep going and going and going, at some point in time, I'm going to need assistance, right? That care is 100% fully guaranteed. It's highly leveraged. It will not change, okay? My premium is guaranteed. My benefit is guaranteed. I know exactly how it's going to work. We can run you a 15, 16-page illustration and say, at what year do you think this might happen? Age 90, age 85, age 82, 79, it doesn't matter. We can point and say, this would be your monthly benefit. And it's going to last between 4 and 8 years. I say between 4 and 8 because that is the general benefit durations that are offered in the industry. Okay, mine goes 4 to 8. You want 4 years, that benefit would be a little bit higher monthly, but the total benefit over those 4 years would be lower than an 8-year, for example. That makes sense, right?
Is the 4 to 8 year continuous or start? Stop,
yeah, you can start, stop. So that's a great question. Is the 4 to 8 years a continuous? So if I had a 6-year benefit period, for example, just set in the middle, and if I qualified for care, if I had a car accident, broke my hips, whatever the story is, right, something bad, where 90 days is the time frame that I need to be unable to complete 2 of those 6 ADLs, as long as it's 90 days or longer, I can get benefits. So let's say 6 months that I need help and assistance. After 6 months, I've been taking my benefits, took those for 6 months. After 6 months, I'm good, I'm walking around, I'm better. Great, my benefits stop. Inflation continues to roll up on my policy on the amount that I have not used. And now, instead of having 6 years, I have 5.5 remaining. Yep, good question. Or I know someday, and this is how it ends for me, is I'm going to die at some point in time, right? So if I live long enough, I'll need care or I'll die. And if I die, no matter when I die, how much of the benefit for long-term care I've used, there will always be a tax-free death benefit paid to my beneficiaries. Always. The more care I use, the smaller that death benefit will be. The less care I use, the higher that death benefit, right? Make sense? Or I can quit. And at the time of application, you'll, with advice from Emmett and Tom, you can pick from one of our 3 return of premium options. We have 100% return of premium, which means if I've had enough of it, I just want to get my premium back and walk away from the policy, I can do that. Full return of premium. I can have 75% of my premium from day one. So if I have put in, one premium of 10 grand and I say this isn't for me, I get $7,500 back and walk away from the policy. Or I can maximize my long-term care benefit and do what we call LTC Boost, which is simply maximizing the long-term care benefit, and I have the guaranteed cash value in the policy as my walk away. Okay, it's all illustrated. It's all very sensible when you see it, but it goes from more flexible to more leverage as we went down that scale. Okay. The other way to quit is what if I have to stop paying my premiums? We have single pays, 5, 7, 10, 15, and 20-year premiums. Others have more extended options as well. But let's hypothetically say I did a 20 pay. Well, if I got halfway through 10 years and I was like, you know what, I want to retire, I don't want to pay this anymore, whatever the story is, I can stop paying premium, take my guaranteed, they're called reduced paid up benefits. I'm going to keep the benefits I paid for, not pay an additional dime of premium. My policy is still there when I use it, when I need to use it for care or for a death benefit, and I don't finish the premium plan. So a lot of flexibility. It's all illustrated, it's all guaranteed, every single value, okay? I get a lot of questions on what does it cover? Are there certain things that would cover versus would not cover? What's the fine print look like in these policies? All that fun stuff. Now, each carrier, each insurance company is a little different with this, right? And there's 2 ways that benefits are paid predominantly. One is called cash indemnity, which is what my company does, which is simply put, if you qualify for benefits, that's your 2 activities of daily living, or that severe cognitive impairment, great. You have to have a plan of care, which we do on our side, that says what care is acceptable for your situation. You have to meet the 90 calendar day elimination period. Okay, so it's 90 calendar days from the day you became chronically ill, and then you're going to receive your benefits each month, every month. We do not care who's providing care. We don't care where it's being provided. What we care is that we're paying you your monthly benefit each month, every month, and you are determining what your care situation looks like. You could be in a facility. You could be paying your spouse, meaning just putting it into the bank. You could be paying your kids, neighbors, does not matter, okay? I get a lot of questions now. Could you buy a robot? 25 years from now, Elon gets his robots out, right? Or, someone else, could you buy a robot? You could. You could use our benefits for that because there are no restrictions. The line item that catches the no restrictions on anything is the informal care. Unskilled, unpaid care providers is what informal care is. We would pay for all care types. We require a plan of care. We do not enforce it. Okay. The other option is called reimbursement. And it's not bad. It's different. Reimbursement is just what it sounds like. I pay for my care need out of pocket. They're going to give me a receipt or receipts for whatever it was paid for. I'm going to submit those to my insurance company, and they're going to reimburse me up to my monthly limit based on the qualified care services that I used. There could be limits in terms of the types of care providers that are acceptable. That's carrier specific. Okay, some are more flexible than others. It's just good to know that there are options out there. So those are the 2 main types, and we're kind of always playfully competing with each other on which one is better. It's not, it's which one you're more comfortable with, is which one is better. Okay? Yes, sir.
Question.
Sure.
You mentioned that you bought a policy, had it for 6 years, and then you decided you didn't want it anymore. But yet, you still have coverage when you go into, how is that?
Sure. So you're referring to what we call reduced paid up benefits. So there is not every state has regulations. So it's a very regulated market. With all long-term care insurance, they have to provide a couple of things. Oddly enough, a 5% compound inflation agreement or rider is an option right? It's super expensive. Nobody chooses 5% compound, even though logically that would make sense, but it's really expensive. That has to be included in them. And then the other thing is they have to have non-forfeiture benefits, which means that's the reduced paid up benefit. If I stop paying premium, if I can't fulfill my premium obligation on an ongoing basis, the regulation makes sure that the insurance company isn't just going to cancel your policy and keep your premium. Okay. So the way that we structure it is hypothetically, let's say I was doing a 10-year premium structure. So I'm 60 years old. I set up for a 10-year premium plan. And in 10 years, this thing's paid up and done. I never have to pay another dime of premium, fully locked in, fully guaranteed. Let's say I get to year 6 and I say, I don't want to pay this anymore. I don't need a reason why. I don't want to pay this anymore. I notify the insurance company, send them an email, phone call, whatever. I can tell my agent, my advisor, they can make the communication for me. And we'll say, okay, we're going to put this into reduced paid up status. And the benefits I have paid for to that point are locked in because I've already paid for them. So everything kind of resets to those new values. But when I stop paying premiums, what happens is my death benefit resets to that new level. Use easy numbers. And these don't have to be the premiums. If I was doing $10,000 a month, I'm sorry, $10,000 a year for 10 years, right? Just for easy math, I paid $60,000. My death benefit would be probably somewhere in the $70,000, $80,000 range at that point. So it's going to reset to that level versus the death benefit expecting $100,000 in total premium, right? My LTC benefits, let's hypothetically say that was buying me $8,000 a month in LTC benefits when I'm age 80. Well, it's going to reset to what I've paid for because I've only paid $60,000 out of the total 100, right? So it resets to what I've paid. But the cool part is, one, I don't have to pay any additional premium, so I have that flexibility. I have that in the back of my mind. But two, the inflation that I've put on the policy, because I've prepaid that inflation as well, will continue to inflate those LTC benefits even when I'm done paying premium.
So I would never have to worry about care.
Correct. Yeah. Your policy would still be there for you.
And the facility I'm in,
Hmm?
whenever I wouldn't have to move to a Medicaid, there would still always be money.
Well, for that period of time, for your benefit period duration, right? I can't say it would always be there or that it would cover 100% of that need, right? But it would pay up to the policy benefits. And then what happens after the policy benefits are exhausted, right? I can't predict what happens from there, but it would pay out the full benefits of the premium that was paid into that policy, whether or not you paid the full 10 years or only a portion of those 10 years. And the cool part is in our illustration, there's a grid on every single one, and it's very, very straightforward. It'll say year 1, here's your reduced paid up amount. If you only paid 1 year of premium, here it is. If you paid 2 years, here it is, and so on. And it does that for every year.
Oh, okay.
Yep.
Would you restart it?
No, once it goes reduced paid up, it stays reduced paid up. Yep. Yes, sir.
You use the word guarantee, but that's based on the claims paying ability of the insurance.
Sure. It is. Yeah. So I'll give you a little insight into SecureCare. We're approaching 150 years in the insurance business. We started as Minnesota Mutual. You can look all this up. I think we're 146 years in the insurance space. So we've been paying death benefits and paying claims for 146 or so years. We are one of the oldest. So Pac Life was just at a conference yesterday. Pac Life, you guys all familiar with Pacific Life? Yeah. I think they just celebrated 160 years. So once you're over 120 years old, you're doing things pretty good. We're a mutual company, so we don't have stockholders. We have policyholders. We answer to our policyholders. We don't make instant drastic decisions based on a stock price. So we're a very stable company. There's this cool thing called a Comdex score. Comdex score takes all of the rating agencies' input, if you will, and then puts it into a number, a value from 0 to 100. I've never heard of anyone being below about 30 or so. They generally go bankrupt. We're a 96. So the hundreds out there, Northwestern Mutual, New York Life, Mass Mutual, those huge, massive companies that have huge sales forces, We are literally 3 notches below those, 4 notches, sorry. So, you know, A+ rated at AM Best. Again, we can get you all the stats on it that you wanted, but yes, it is based on the claims paying ability of the company, which our history and our claims paying ability is better than almost everyone else out there. But I love the question. Any others?
You had a quick comment, I think before, that some of the insurance companies set up go into any facility. So is there like an in-network and out of that?
No, so what I was referring to, and it's not really facilities where it becomes an issue. So some reimbursement plans where they're reimbursing you for benefit for cost that's actually incurred, they won't reimburse some of them for informal care or family provided care. So in other words, you'd have to have a service coming to your house, a home care service, or you'd have to be in a facility. Those details are laid out in each individual policy. So our policy says the language is something to the effect of, your care is your choice. Here's all the various things. You saw that list earlier, including informal care. We require a plan of care. Everyone does, but we don't enforce it. It's 100% up to you. But there are some that are more specific, and they'll say, these are the 8, 10, 12, however many qualified care services. So it's important to understand what's in the policy. Some are more flexible than others. But everyone that I know, I'll say it that way, every policy that I'm aware of is going to pay for every type of facility that currently exists today. Informal care is where things get a little grayer, I'll say. All right, so I'm going to wrap this up here in just a second. So the last thing that I'll share, I mentioned this earlier, claim concierge, care management. What are the resources? A lot of policies have this now. It is hugely important and hugely beneficial for not only the policyholder, but the family. Anybody filed a homeowner's insurance claim or an auto claim? Is it fun? No, it does not meet the definition of fun, right? Yeah, so, and I apologize if there's any P&C agents in the room, but it's not fun, but they know that already. So we have built this within our own claims team, and it is essentially a one-stop shop. So if something's happening, let's hypothetically say my father had a policy. He unfortunately does not. Hey, dad has Alzheimer's. He doesn't function great. What do? We don't know what to do. Great. Call the insurance company. We call the claims team, and they're going to say, okay, great. Tell me what's going on with that. They'll do some intake questions, figure it out. And they will say, yes, this is a claimable experience that he's having. We need to move to the next step. The next step is more intake questions. But the first thing they're going to do is assign a care manager. That care manager is going to walk. My dad would be incapable of having a phone call conversation like this. They're going to walk my mom or me or my brother or whoever ends up calling on his behalf through the entire claims process. Here is what we need to do. Here is what they are going to do as the claims team, which is almost everything. Obviously, we can't make your own signatures. That's illegal. But here's the form. Your doctor signs this. Here's this form. You sign this, right? We go through that process. That claim manager, that care manager that's assigned, isn't just with you during the claim process. They're with you the entire duration of that claim. They are with you until death, okay? So if you have a 6-year benefit duration where you're receiving LTC benefits for 6 years, if you're still living after the end of 6 years, if my dad was still alive after he exhausted all the benefits in that policy, that claim manager is still going to be there because there's still a death benefit that's going to pay out at the end at some point in time when he does eventually pass away. That claim manager is a great resource. Hey, my dad, as I mentioned, he is at home right now. He lives with my mother. She provides that care. One day she could finally say, look, this is too much. What do I do? What options do I have? I need to move him into a facility. What do I do? Okay, here, Mrs. Swayze, here are the facilities in your area. Here are the memory care facilities. They're rated. Here are the phone numbers. Here are the administrators. Here's all the information you need to know to start having those conversations. You don't have to go do a Google search for this. You can, but it's all there. It's all provided. Great. He's in a memory care facility. Maybe he hates it. Maybe my mom hates it. Okay, call the care manager. This isn't working out. How do I move it? They're going to give you those resources, right? So they're going to be with you that entire process. It's a huge value. Companies actually sell these a la carte, and a lot of folks decide to pay for these because of the value that they provide. This is included in every single policy, and we're not the only one. Most insurance companies nowadays include this in their policy benefits. All right, so wrapping this up, again, hopefully if you took one thing from it, have a conversation. Spouse, grown adult children. My youngest is 10. I'm not having a conversation with him. That'd be a waste of time. I'm not having a conversation with my 19-year-old either. That's kind of a waste of time for me. But I am having a conversation with my wife. I made sure I had the conversation years ago with my parents. Today it is proving highly valuable to my mother that I can remind her, this is what dad said he wanted. When was it okay to do these things? And we are reaching that point, right? Still impossible decisions to make. You always will feel like you're wrong, but you can always rely back on those conversations you have. So start those conversations, have them. They don't have to be 1.5 hours long, right? They don't have to be this big ordeal, but have those conversations. What does it look like? Who's providing care? Where is it provided? What do we want that to look like? Sit down with Doug and Tom. I'm sorry, Emmett and Tom. I don't know why I said Doug, my apologies. Sit down with them. Have that conversation with them. This is what we want it to look like. Talk about leveraging dollars, right? Sometimes it makes sense, sometimes it doesn't, right? Sometimes health works, sometimes it doesn't, right? But there are a whole lot of options outside of my little small world that I talked about today that they have full access to, okay? The biggest thing, plan, have those conversations, take care of your loved ones, and certainly thank you for your time today. I'll be hanging around, so if anybody has any questions, I'm happy to address those.
How would that work with, so if you are getting paid? Get rid of all, I mean, you have to spend on everything.
Yeah, so each state's a little different. I don't know Illinois state law. There are Medicaid experts certainly that you could have access to. You would have to spend down your total net worth, your assets, to below a certain level. It's going to be different if you're married and your spouse is still healthy, because they do have provisions where your spouse is expected to live, thrive, and survive, right? Things like the home they can't take. So there are accommodations for that, but you really have to spend down those assets to a bare minimum level. And most of the income that's coming in, whether it be Social Security or other things, is going towards that facility, that Medicaid facility. So, but it's state specific. I know Atlanta or Georgia a little bit better, but I just don't know that great as far as diving into knowledge. Yeah.
I can tell you, Illinois, the spend down is 17,500.
There you go.
Well, I mean, if you're receiving a benefit from insurance, how is, Medicaid? So you're receiving that benefit, you spend out all of your other money.
Yes.
Then it's Medicaid.
Yeah. So
a remainder of it, or?
So well, this would probably more than likely be paid directly to the facility at that point, is probably the requirement that they would have. So because it's cash, we prefer to pay it to you, but we can pay it to any facility or any care provider. So more than likely, I would assume Medicaid would want us to pay them directly for the benefit duration that's left. But that would be assuming that depleted all of the other assets and all you really had left was this benefit payout. Yep.
State has the lowest cost of in care.
Which state has the lowest
if you
cost
have
of
to
care?
move to somewhere, get out of the state that has the lowest cost.
From what I've seen, it's also the poorest state, which is Mississippi. Yeah. Some places are nice in Mississippi. Hot, I'll tell you that. My son goes to Mississippi State, so I don't know if he'll stay there much after school, but he loves it. Yes, sir.
I bought long-term care about 16 years ago, paying into it.
Okay.
I'm interested in that hybrid. Can you convert, or do you?
So you can't convert. I'd be happy to kind of chat with you sidebar, because I spent 10 years at a company that did a lot of the traditional stuff called Genworth. You may even have the Genworth policy. Okay. So you've probably seen those premium increases I mentioned. The hard part is when we price out what you currently have versus the price points today at current age, a lot of times it doesn't make sense, right? So now there are other factors to take into account, potential future premium increases, those types of things. We can certainly run some numbers for you and see if it makes sense. at least just from an exploratory perspective, we can certainly do that. But I feel a lot of those. Excellent. Well, thank you, everyone. Make sure you read the disclosures. Best part.
Oh, yeah.
Yeah, my compliance team's gonna call and say, hey, did Mike show the disclosures? So now you can say yes. Thanks a lot, Mike. Absolutely.